Now, to Todd's point, if you have no debt and you're in your late 50s, is it still worth having? And maybe this is where you enter the chat and say, well, life insurance is an umbrella term.
Yeah, as you said, so when we're talking about these insurances, we are talking about like income protection and disability cover. So in your late 50s, you're probably likely still relying on your income. Now, if your work is optional, hey, we could retire today, but we're choosing to work part-time, or, we just want to accumulate more wealth to make retirement even more comfortable, then maybe that's an area where you don't actually need any of the cover, because we're not protecting a loss of income, because if the income wasn't there, we'd still be comfortably retired. Now, in this day and age, people are retiring with more debt than they ever have, 10 years ago. So,
well, not even retiring, Phil. There's people in their mid-50s carrying a lot more debt because of the nature of house prices and property.
Yeah, exactly. So it's not always the exact equation, I'm 5 years away from retirement, I don't need any of these covers. Sometimes there may be a requirement for cover. And this is where it is a delicate conversation of going, okay, let's first assign, the level of cover that is appropriate to hold today. And then let's have a conversation on premiums. And that's really the next thing, because sometimes you may have a need for insurance, but it's unaffordable. So, okay, we are taking the risk that if something happens, it's going to impact our wealth goals and our retirement planning goals. But because of the cost of this cover, we're making a conscious decision to either dial it right back well below the level that we require, or cancel it altogether based on that consideration.
At the risk of using dumb analogies every time I open my trap, it really isn't, and I do make myself laugh, Phil, don't worry about it. It really isn't any different than, let's use pet insurance, right? For me, based on my financial situation, if I got a pet tomorrow, I'm not paying for pet insurance, knowing full well if little doggy or catty got sick, a vet visit might cost 10 or 15 grand. It may do that. In my life, I'm cash heavy. I'll take the risk and not pay for pet insurance. There is a carve out with pet insurance where if you want it, it's cheap, pay for it, get on with your life anyway. But I've made the decision to self-insure because I can cover that need. When it comes to my own life and income, if I couldn't work tomorrow, sure, my assets are probably going to run out sooner than my life is going to run out. So I need to transfer that risk of me having to carry it to an insurance company to pay for my disability cover. So
exactly.
If the need isn't there, I don't insure it. So I don't need to insure my cat or my dog because I've got the wealth to cover that, and I'm happy to flip a coin, and if I decide not to cover the dog and it has renal failure next Thursday and it costs me 10 grand, well, I've laid in that bed I've made for myself, knowing that I've declined taking the insurance.
And the thing about, and the difficult balance when it comes to like income protection is we're protecting your income. Like, what's the max a vet bill is going to cost? Let's say $20,000. Now, I'm sure there's listeners who are going to tell me that they spent $100,000 on their pet. But the loss of income for a year or early retirement because of a health, event, if you're retiring 5 years earlier than you otherwise anticipated, well, that may be a really significant loss of income or a loss of assets. Because really, when you're closer to retirement, you're thinking about how do we build up an asset base that we can live off. And so if your projections and your modelling has said that we are going to comfortably live off our asset base until age 120, likelihood you're not going to get to 120. And so therefore that protection of income isn't that necessary. But if your projection says, or if you haven't done that body of work, or your projection says that actually we need to build up another $100,000, $200,000, $500,000 between now and retirement, then okay, well, the way in which we build that asset base is the income. Yeah. And so we actually need that income. And so that's where these equations come into play. And it becomes infinitely more complex as you're getting closer to retirement.
Now, if we loop back to that first question I asked you, like what are the questions that I should ask at my next review? Like the first question is the current level of cover that I've got matching the current need.
Yes.
And then it will flow to price and do I risk not insuring? Do I do that? And we're going to talk about price right now. This episode is brought to you by Skye Wealth. Phil and the team at Skye Wealth, they are specialist financial advisors who only deal with life insurance, income insurance, total and permanent disability insurance, trauma insurance. You don't do pet insurance yet, do you?
No, we don't. I don't think we ever will.
Some of us being called dogs before, but anyway, thanks Skye Wealth. My name is Glen James and you're listening to Retire Right. Phil, the question about is my current cover matching the current need, more or less?
Yep.
As we get older, we know that insurance can cost more, so price does enter the chat. Correct. I'm kind of the view, and I'm going to ask you this question, how do I compare a premium without falling into, I just need the cheapest, and have a think about that while I go off on this tangent. I think when it comes to insurance, the later we are in life, the more financial resources that we have in life. It's all about starting with how much do we need, what is the shortfall, and how much does it cost to cover the shortfall.
Yep.
If it costs too much because of our age and we're earning $50,000 a year and this cost because of our age is $10,000 a year, we live in reality, there's got to be some type of trade-off. So that trade-off is we spend a lot of our money insuring this, which most people wouldn't, I probably wouldn't, or we understand there are risks in life. We don't want to absorb all that risk, so we might dial down the cover to make it affordable and have this balancing act of life's full of risks. We want some cover in place, but we don't want to spend all our money on insurance.
Yeah, so let me go off on a different tangent. My second question is actually more about your health history, and the question I would be asking is, can I move insurers without
compromising the policy?
Without compromising the policy? Because that does impact the conversation on price. So it's kind of a precursor to price, because if price is a factor, which it is for everyone in insurance, but especially as we're getting closer to retirement, it is becoming more expensive. Your options become limited if you have to stay with the same insurer. So if you have options for multiple insurers, okay, maybe moving that policy. Some insurers, they're giving initial discounts in the first few years, and so we can actually move and save money on that policy, and that's one option. But if we are limited based on our health history or our current health situation, then that does limit our ability to play around with the price. So a good example is, someone close to me is calling me up saying my insurance premiums are quite expensive, but we're actually in the process of making a partial claim because of a back injury. And so my conversation with them is, unfortunately, we can't move insurers. So we are limited to adjusting the policy based on, will insurers give us any kind of concessions? Are there any kind of added things that we can make the premiums cheaper? Do we need to dial down the cover? We're actually much more limited in terms of our options when it comes to pricing because of their health history. And so that's actually the second question I would lead with is, based on my health history, do you think there's going to be any limiting reasons why we can't potentially shop around insurers?
So how do you, other than health, and maybe I'll ask it a different way. So if someone is, and we'll assume there are listeners who are in their 50s, right, who only have the default cover in their super. Well, let's just assume death cover. I'll make an assumption. We've got a couple in their early 50s. They've got teenagers still or young adults still living in the house. They've still got a mortgage, call it $600,000 mortgage. They've only got the default cover in their super fund, and I've never, as far as I've been on the planet, seen a default level of death cover be nearly enough for what you need in the real world. So we'll assume someone in their 50s are listening to this. They've got debt, they've got dependents, they've only got the default $300,000 or $400,000 death cover in their super fund.
We do. At that age, it's probably more $50,000.
Whatever it is, I'm being generous.
Yeah.
And they're like, I need life insurance. Saw some dumb ad on the morning show and jumped online. Oh, this is cheap. Why are you laughing? Is there any traps with just going, can you just get a cheap death cover policy and get on with it? Like, talk to me about this, why the cost can't lead the discussion.
Yeah, I mean, so there's a bit there that you threw at me, so
Yeah.
I'll try and pick up the pieces. So some of the ads on daytime television talks about like no medicals and some of those things. So there is, risk there, and also they're often not cheap as well. So, some of those direct offerings, there's a lot of hesitations I have when it comes to that because the price is commensurate to the fact that they're advertising on daytime TV and spending a lot of money on their marketing spend. The claims experience may not be as great in those scenarios. So. But let's just talk broadly about they've got default cover. There is a level, so that's where the first question comes. What level do we actually need? Actually, $600,000 worth of income. You're going to be working for another
$600,000 worth of debt, not income.
Sorry, of debt. Yeah. So we're going to need to protect that or protect a portion of that. And so let's talk about that. Let's talk about from a health point of view, do we have options? Because if we're not going to get any insurance anywhere else, then that stops that conversation in terms of moving or looking elsewhere. And then next is price. Okay, we are paying X amount. Is that appropriate or not? Can we save money or can we not? What are some things that we can do with the existing policy that we have? Or do we have, ability to move? And then how do we adjust this? And so, basic life insurance cover is generally relatively easy to obtain, whether you go direct, go through your super fund, go through an advisor. It's relatively easy. It's more those living benefits, so trauma, income protection, disability, that does become a bit more complex based on your medical history.
So, and I think this is why. So, if you are listening to this episode and you've lobbed in from the Money, Money, Money podcast, I recorded a podcast specifically to the Money, Money, Money audience with Phil on insurance, and now we're doing one dedicated to the retire item, not just mirroring. How do I say that word? Whatever.
Yeah, mirroring.
Yeah. The two episodes, because it is different. If someone lobs in and they're in their mid-50s, early 50s, for example, and they've got the teenagers who are probably done with home in 5 years, and there is that $600K mortgage, but the house is worth over $2 million because they were lucky to buy a house in Australia and it's a decent size and all that stuff. Like, sure, on paper with the advisor, it does say that, well, based on what you've told us, to clear the mortgage of $600,000 and to provide some replacement income for the non-working spouse means that you need, I'm making a number up here for the illustration, you need $1 million of death cover.
Yep.
Now, you would, as the advisor, and your advisors would say, look, based on just what you've told us, you need that $1 million of cover. Here is the most tax effective and estate planning effective way to fund that. Because if you've got blended family, you might not want the dump policy on TV. You might want it in super so you've got more control of where the freaking money goes. That's another thing. What if they say, well, at the end of the day, both kids are 16 and 19. Within 5 years, they've gone anyway. As a family unit, we're comfortable not to insure the full $1 million of replacement income. We just are happy to either just get a $600K policy each to clear the mortgage and get on with our life, sure, because that's when price does impact. As a professional, you need to tell them, based on everything you're telling us, the book says, and we've got professional indemnity insurance. We can't just be like recommending lower amounts just to get a sale. Like, we've got to recommend what the need is to be replaced.
Yep.
That's when the nuance and the discussions can come in with your clients and the advisor to say, well, if you don't want to pay that much or whatever, we can bring the cover down.
Exactly. Yeah, we always have an overlay on affordability.
Right.
That's something that we personally make sure we think about from a client's point of view. Now, that affordability assessment is fairly generous in terms of we will allow higher levels of cover, but as you said, that's the starting point. Let's just talk about, here's our professional advice and this is how we got there. But let's talk about, because $1 million worth of cover for one 50-year-old, that could be $1,500 a year. on a big level of income, and that could be very comfortable and easy for someone to afford, or it could be $10,000 a year. And so on a much more modest income. And so those two scenarios are very different. If someone's on a modest income and it's 10 grand a year for that policy, okay, we as advisors, we are, before we even get to that meeting, talking about lowering that cost of cover. And we will make advice to cover the lower amount because we need to be protecting that super balance as well. So it is a part of our code of ethics. I'll geek out a little bit. It's about our code of ethics to make sure we're considering the broader impacts of our advice. So even though we specialize in insurance, and that's the thing that people have come to us to give advice on, we can't just ignore the impact on their super balance. And we can't just go, well, your retirement savings doesn't matter, bleeding your retirement nest egg, is not an impact because we're always going to maintain this insurance cover. We need to make sure we are considering that. And so we will bring down the level of cover and say, hey, we are recommending you be underinsured. We think you need $1 million still, but we're recommending $500,000 because of the high level of cost for a whole number of reasons. Maybe there's health impacts, maybe there's occupations. Some occupations will have different costs. Maybe you're a smoker. So there are a whole bunch of impacts that will go into that cost, and we'll bring that into consideration. But that's when the conversation starts with our clients of this is what we've done. And some clients increase the cover and say, yeah, I'm happy to pay more, or because we feel like we need it, or actually even that's too high. Let's bring it down even further.
Again, at the risk of a dumb analogy, it's really hard when you see comments in the Facebook group and if you want to join the Retire Right Facebook group, just search Retire Right on Facebook, click join, where it says, where did you hear about the group? Please put, I heard Glen and Phil on YouTube or on the podcast, because I know you're not spam. About 90% of people who join are fake spam accounts. And I get it. People want to know. So people are like, how much is everyone paying for their car insurance this year? I just got my renewal and it was $1,500. What's everyone else paying? Lol. Okay, different car, different age, different driving record, different location where it's housed, probably other things, different gender, different age of the driver. It's no different with life insurance because it's such a personal, tailored thing to the policy, whether it is for the car insurance or the life insurance.
Exactly. And someone's comfort level is different. So even everything else being equal, one person paying $2,000 for life insurance may feel like that is more than enough and really comfortable paying that because we want to protect that need. And someone else may look at that $2,000 bill per year and go, that is way too much. That's a waste of money and I want to reduce because they've made a conscious decision to not cover as much and take on more of that risk themselves. So even just pure comfort levels, which is just the immeasurable, how does it make you feel, may be very different, even though the cost and everything else is the same. Yeah,
my parents, before they retired, they both had like a $200K death policy. And it was actually relatively cheap. It was on an old level premium. And they had stopped working, or they were still working. Dad was still working. Mum had fully retired. And they're like, should we cancel these policies? And looking at the situation, if either of them died with no mortgage, no income to replace because Dad was working because he didn't want to retire, they had super, they had the mortgage, there was actually no financial need, but they just decided, nah, we want it, it's cheap. If one of us falls off the purse, it's a little bonus, who cares, At that point, it's just a luxury that they've chose to pay for, right?
Exactly. Yeah. And that's where, again, that comes back to the comfort level. There is no need. There's no requirement. It's the money that's going down the drain if you don't claim on it. And let's hope your parents don't need to claim on it because it means they're dying earlier than before it gets crazy expensive.
And then when Dad stopped working completely, they ditched the policies.
Yeah.
And then
that makes a lot of sense.
They both actually died the next day after cancelling the policies.
I should laugh about your parents dying.
I'll send that to Marshall.
Only because I know that's not true.
It's like when people are like, I don't want to get a will because there's this vibe where if I get a will, it means I'll die sooner.
But I mean, to that point about cancelling, like that is a real thing is this bias towards cancelling the policy because, well, I've been paying these premiums for so long. That is a real thing when it comes to getting closer to retirement. People are unwilling to cancel the policies, even though there is no need, because they're like, well, the premiums have been going there for 20 years, 30 years. I've been paying for this. I want to maybe see something back.
We sold the second car because we don't need it anymore. We weren't upset about cancelling the car insurance policy on the second car.
Yeah, and so that's definitely something that, as people holding these policies for a long time are even reluctant to cancel, which is something that, we just got to be very pragmatic and go, if it's something to hold just for feel good, great, let's keep it. But
say out loud, we're paying this
as
as a luxury, knowing we don't need it.
Yeah, exactly.